On 1st April 2021, Mohan Limited sold the goods to Mr. Hari Limited for consideration 750,000 consideration. A receipt of its receivable in a three equal installment of 250,000 every year over next 2 year period from 1st April 21 to 31st March and 31st March 23. Okay. And the company is offered discount of 5% if the payment is made in full at the time of sale. Sale agreement reflect the implicate interest rate of 5.358%. The total consideration receivable for such sale is 750,000. Hence, the management has recognized the revenue for the sale of goods for 750,000. You are required to analyze the above accounting treatment made by the accountant in accordance with the Ind AS, and it is, if not, advised the correct treatment along with the journal entries and extract the statement of profit and loss account balance sheet. So, 750,000 out of it's been paid three times. 2.5 lakhs in 2.5 and 2.5. So when we account it, we should account for interest too, because the amount is settled not only in a single payment. The only 2.5 is paid here. Next 2.5 is paid later 1 year. So we should account for interest. The above treatment need to be examined in the light of the provision of Ind AS 115. The determining the transaction price, the entity shall adjust the promised amount of consideration for the benefit of the time value of money. If the timing of the payment agreed to be by the parties to be contract either explicitly or implicit provides a customer or the equity will be significantly benefit the financing of the transfer of goods or service to the customer. The significant financing component may exist, either regardless of whether the promise of financing is explicitly stand in the contract or implicitly payment in terms of by the parties to the contract. The objective when adjusting the promised amount of consideration for a significant financing component 2.5 lakhs, 2.5 lakhs, 2.5 lakhs. The entity is recognized a revenue at the amount that reflects the price that customer would have paid for a promised goods or a service if the customer had paid cash for the goods or service when they have transferred to the customer. In this case, the present value of 110.999 and 9.9 0 1 2 into that. So we will get out 7,50,000, sale is 7,12,000 and 500. The company agrees to defer the cash flow of sale, which recognize the revenue from sale of goods and finance income as we follow. Cash 2,50,000, trade receivable 4,652, 4,52, 62, 500. So sales. Then cash 2,50,000, interest income 24,000, 2,25,000, and cash on the third year 2,50,000, 12,715 is trade receivable 2,37,251. The balance sheet and profit are extracted the following percentage of the years as per 31st March and 31st March 3. So in the NDA's complaints, Division 2 and Schedule 3 need to reference to the presentation of the balance sheet and profit and loss account on 31st March 2 and 31st March 23. Asset trade receivable for 31 இருக்கும். 23ல 0 ஆயிரும். Income sale of goods 7,12,000. Total sale will be 7,12,000. But next 2 years we will consider income, other sources 24,741, 12,000 719 will be the interest income. So the conclusion is not only we should account for both. Here you can see total sale value this is, but receivable 1, receivable 2, receivable 3. The difference is interest. Difference is interest. We should account three of them to account as per Ind AS.